Hi, you're watching Investor Insights, and in this video it's all about the taper. Good old taper talk and the Fed's conundrum. In order to try and keep this video as short as I can, most of the background discussion and most of the economic theory I've already presented in an earlier video of mine called Sound Economic Principles and Why the Fed's Got It All Wrong, the link of which I've put in the description box below. Have a watch of that if you aren't familiar with several of the concepts that I'm going to get back into today. But essentially, everything that has happened is basically as a direct consequence of perception and reality. Now, just bear with me for a second. In life, there is a big difference between perception and reality. And to illustrate that example, a case in point would be looking at economists. Now, they want the public's perception of them to be people of great intelligence and awareness and the ability to skillfully maneuver economies out of bad situations. And how do they try and achieve this feat? When they talk, they use big words, and they have an uncanny ability to grow really cool beards. The reality, however, is far from the truth, because it's far from perception, because all that they instill in people like me is that these people know big words, and they are either too poor or too cheap to buy razor blades. If you're on another case of perception versus reality, I always talk about going to the gym, and in your mind, your perception is that I'm just a clone of Arnold Schwarzenegger. But the reality is, I wouldn't even fit in his left thigh. So what's this got to do with the Fed and even the taper? Well, essentially, it's all about setting an image and putting on a facade of an economy that is recovering and in fact is growing strongly. But beneath the surface lies the reality. And even as recently as a couple of days ago, the balance of trade numbers came out for the US, and it can be shown that the trade gap, the difference between imports and exports or vice versa, turned out to be the lowest in 4 years. It stood at about 35 billion, just shy of 35 billion, where the analyst expectation was it was going to be hanging around 40 billion. And that's because of a huge jump in exports to record levels. Now, if one was to look beneath the surface, then the reality is not that good, because essentially the record levels of exports came as a result of a huge number in terms of exports of crude oil. America is now a producer. In terms of manufactured goods, it's nothing to boast about, which still leads to strengthen the belief that America is not really a productive nation at all. Like Australia, it now has to rely on commodities to pull itself out. But that's another video in itself. And even the number itself, 35 billion, is nothing to sneeze at. They call it a trade gap, but to most normal people like you and I, you would perceive a gap to be something like that. In fiscal terms, you would be looking at several hundred, if not several $1,000s. 35 billion is a huge chunk of change. If they were lucky to be able to maintain this level of balance of trade, then this year they'd be looking at 31, 12, 16, you'd be looking still at a number north of $400 billion. And 400 billion simply means that they've added another 400 billion to the debt load. And this further shows you that the economy is one of debt finance consumption, because they just keep on accruing more and more debt because the stuff that they produce nobody wants, or they just don't produce anything, and the latter being the actual reality. Now, if you're not familiar with such big terms, 400 billion would, in US dollar terms, would be roughly half of Australia's gross domestic output. So it's nothing to sneeze at. And that's just the difference between what they import to what they export. So go figure. I mean, they could be backslapping and high-fiving themselves over such a number. They combine it with the 4.1% GDP print in December, and everybody believes that, yeah, this is going to be a very strong recovery. Well, we'll see about that, but that's for later in this discussion. Now, getting back to perception versus reality, it's a very difficult game to illustrate to the world that you're a recovering economy and that the world should invest their hard-earned savings within your economy. Because if you were to look at the case of Joe Blow and Chin Chon, Joe Blow used to be a production superstar. I mean, he would make all sorts of goods and provide heaps of services. He used to work really hard, and he was lending everybody money. But eventually he got fat and lazy and realized that it's easier to borrow of others to consume than it is to work for yourself and save and consume. So enter Chin, who's dumb enough to be able to lend money to Joe, believing that he's going to come good one day. And Joe has to put on this facade to give Chin the perception that this guy is past, that the worst days are behind him, and he's on the way to a full recovery, in that he's looking for work every day, he's getting re-educated, and he's buying all sorts of tools for his future job, whatever needs doing to convince Chin that he's on the way up. And Chin is either too gullible or too stupid to realize that it's all just an act. So if you were to look as Joe Blow as the American economy personified, and Chin Chong to be one of the Asian manufacturing superpowers, that's what's happening around the globe today. America has to give its creditors the perception that it's a very productive and forward-going economy, not one of fat lazy slobs who just consume and borrow and live off others to perpetuity. Now, what do you think is going to happen the second that Chin Chong realizes that Joe Blow has been bull dusting him the whole time? That every time he turns up to check on Joe, he's looking through the newspapers, he's talking to potential employers on the phone. It's all just an act. The second he turns his back, Joe's back on the PlayStation or on Facebook talking crap or whatever he does during the daytime to pass the time. But essentially, Chin Chong's going to realize that all the IOUs that Joe Blow's been giving him are going to amount to nothing, and Joe is just going to lie and consume his way to the end of days. What's going to happen? Well, Chin Chong's going to pull the plug and tell Joe to get lost. No more goods, no more loans, you're on your own. And that day is a lot closer than you think. Because as America's debt pile just grows exponentially, I mean, look at it this way. 8 billion in 2007-2008. now stands at 17 trillion, and they just had to up the debt ceiling. Now, this administration, this one and a bit term administration, has managed to double the national debt in the space of 5, if not 6 years. Of course, it's all in collaboration with the Federal Reserve, which should hold no credibility whatsoever anyway. But essentially, they need the world and its creditors to perceive them as being a productive and healthy economy. All the data suggests otherwise. But then, people like to analyze the data in such a way that they can put a positive spin on everything. And especially when it comes to positive spins and perception and reality, one has to look no further than the recent government shutdowns over in the States last October. Now, what really happened? Essentially, nothing has happened. The government ran out of money. The government never really runs out of money. What does the American government do if they need to pay a bill? Go to the printing press. How much do you need? Beep, beep, beep. Print it out and hand it out. That's all that they need to do. So essentially, why was there a shutdown? Because in life, or in movies or whatever, for there to be a hero, there must first be a villain. So the government, the policymakers, had to create a demon, a villain, out of thin air, so that when they slay it, or they abolish it, they will come through looking like heroes. So therefore, they spawned this government shutdown. This supposedly quagmire, or you can say stalemate between the Democrats and the Republicans about government spending and trying to raise the debt limit and running out of money, and how it is socially irresponsible to just print money ad nauseum because that's going to spark inflation, which really doesn't exist. No. Absolute load of bull dust. They created a crisis basically out of thin air, so that when they solved it, hey, everybody's cheering and the whole world breathes a sigh of relief when they realize, oh my god, they've finished the shutdown. My god, life can go on. Thank goodness that they managed to do something. Well, as a little side play, I mean, the Fed was considering tapering in October, and certain political commentators and certain financial commentators who can see beyond this perception, or they can actually speak about reality, even went as far as to say that that was one of the reasons why they perpetrated this whole government shutdown saga, was to be able to let the Fed delay this taper for another few months. But that's not what discussion is about. That's just what some people like to hypothesize. So, as I said, shutdown, it really doesn't really mean anything. I mean, nothing happened. Stock market still went up, nothing happened. And then what followed was the debt ceiling debate. And again, it is a political debate between two parties, of which none of them is going to let the economy, the American government, fall into structural default. It's never going to happen. I mean, no politician is going to have to put his job on the line for the game's sake of doing the right thing. It's not going to happen. So essentially, yes, you did see some political sparring between the Democrats and the Republicans over, it's unethical to raise this debt ceiling, you should be doing more to pay off the debt, you should become more productive, yeah, blah, 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 blah. But you know what? That's the same rubbish you heard 2.5 years ago. Nothing's changed. The debt ceiling will keep on going higher and higher because the debt that they have is incurring more and more debt as interest rates goes up, which is actually a point of discussion later on in this video. They had to show the world that they were willing to fight it out in order to show some fiscal conservatism and responsibility by not allowing this debt ceiling to be raised any further unless severe structural changes were made. Well, not even structural, some fiscal policy were amended. Well, you know what? It was just political sparring. Eventually, it got done, probably at the last minute, just for show, and the whole world breathed a sigh of relief, especially the debt holders thinking, oh my God, if they don't raise the debt ceiling, they're going to default. And our debt's going to be worth, good old toilet paper. Well, you know what? It is worth toilet paper. It's just that you perceive it to be actually worth something. Now, it's very important at this stage to not think of it as a philosophical discussion. This is actually the reality of the situation. The whole world is looking at America, the Fed and the Treasury print money to perpetuity. And as I have discussed in one of my earlier videos, if you have a cause, then the effect will follow through in due time, irrespective of how much people try and prevent what I call the inevitable. So if you print money to perpetuity, then what's going to happen is that's going to lead to inflation, and if you print enough of it, it's going to lead to hyperinflation. Look at Germany in the Second World War, and in the more current example, as I always use, the good old Zimbabwean $100 trillion note, one with 14 zeros. That still couldn't buy you the paper that it's written on. So the Fed wants to print a crapload of fiat currency. They keep interest rates at close to zero so that the banks can use the Fed's funds rate at close to zero to buy these toilet paper treasuries that are yielding near 3% on a 10-year, and they make money on the spread. And so in effect, the Fed is printing money that the banks are lending to the government. Now, anybody watching, anyone with any sense of any understanding of financial systems and economic principles would realize that this game can't go on. Well, it has gone on. It's gone on for years. So what's going to change all that? Well, as long as the policymakers and the Federal Reserve puts forward all these little plays, little acts, these little token gestures to the rest of the world to illustrate that they're doing a good job to try and cut down on debt, to try and slow down inflation, to do whatever it takes with the tools that they have, both fiscal and monetary, to bring the American economy back from the brink to once being an economic superpower. That's why the Chinese and Japanese and Arabs are still holding on to trillions of dollars worth of these American toilet paper, because their perception is that it's actually happening. But the reality is far from perception, as once more. The data that's coming out of the US on the surface looks okay, but if one looks beneath that, there's a lot of holes in that hypothesis. And look at employment. 3/4 of all the jobs created just in 2013 were part-time jobs. Now, technically, the Labour Department labels a job as a job. It doesn't matter if it's part-time, full-time, permanent, whatever they want to label it, it's still a job. So if you had a job to hand out flyers outside a Chinese restaurant for only 3 hours a week, it still counts as a job. The status of that number is the same as a person who works 40 hours working for some firm. It still counts as one job. But to those that are realists, they realize that part-time jobs don't really add up to anywhere near a full-time job, because essentially a part-time job does not pay for full-time bills and full-time lifestyle expenses. One cannot look at a part-time job anywhere in the same scope as they do a full-time job. So essentially the employment picture is not as rosy as what the Labour Department pictures it to be. But Labour is just one gauge into the economy, albeit the most important one. Things like the balance of trade, which I've mentioned before, and other statistical measures that they use to show how well an economy is performing, so even things like inflation, they're subject to manipulation. So, as I said before, this perception of the world, of the perception of the American economy by the rest of the world is very important for the Federal Reserve and the policymakers, because as soon as that perception changes, the end game will automatically arrive. And the second that China or Japan or the Arabs realize that inflation is running at 8 to 10% realistically, and that the toilet paper treasuries that they have is only yielding 3%, guess who's going to push the sell button? Because it totally contradicts the definition of the word investment, that being the allocations of one's monies into an asset that gives you a rate of return greater than that of inflation. You are talking about debt loads in the trillions, and debt holdings by all these creditor nations that are multi-trillions. The market would collapse instantaneously, and the whole market that is American treasuries, which is a Ponzi in itself, will disappear overnight. And essentially, most people don't really understand the concept of bonds. So, just a quick recap. A bond is just an IOU issued by a sovereign state. So, an American treasury is just an IOU written by the American government to anybody who's dumb enough to buy it and thus lend the government money. But that IOU is a financial entity which is written in US dollars. So the more IOUs you hand out, essentially the more dollars that you owe. So by printing IOUs, it's like printing money. So the greater the amount of debt that you print, it's like printing more and more US dollars. Now the treasury presses are already running red hot just printing money so that the Fed can buy treasuries to lend to the government in the first place. And that in itself is an attempt to keep rates low through asset purchases in order to stimulate the economy. But that actual stimulus is more towards government spending, because it's government that's borrowing the money, not the consumer. The consumers all tapped out. Last year's Christmas sales were the lowest in 4 years. More data that people don't really want to talk about when you want a rising stock market. But essentially, the whole debt load in America, so whether it be the 17 trillion officially stated by the government, as well as all the unfunded liabilities like the Medicare, student loans, credit card loans, all consumer loans, everything, all the loans put together in the US, debt stands at $100 trillion. That number is so big It's basically a Zimbabwean note. But the good news is that that debt can be very easily paid off. All you do is you print money to such voluminous amounts that that number becomes meaningless. And sure, the creditor nations can chuck a stink and be very upset over it, but essentially, if they were happy to hold on to their debt, those IOUs, well, they should reap the rewards, and they reap what they sow. And in looking at this whole debt issue, the Federal Reserve now has a huge conundrum. And this is what this video is mostly going to focus on. The Federal Reserve itself is holding on to over $4 trillion of treasuries and mortgage-backed assets. The reason why it purchases all these bonds and mortgage-backed assets is that they want to keep interest rates low. Now, I am constantly asked what interest rates really signify, and what does it mean when interest rates are artificially kept low. Well, the simple answer to that is that I always talk about the price of money. Well, interest rates is the price of money. And if you understand the law of supply and demand, if there is a high demand for money, so you have a lot of people who want to borrow, look at the US government, then interest rates should rise. If you have no demand for money, or stagnant or low amounts of demand for money, then interest rates will fall. Now what happens is that the game that the Federal Reserve is playing is by putting Fed funds rate at zero, they're artificially manipulating the price of money so that it sends false signals to the economy that there's a lot of cheap money, you should borrow it because nobody else wants it. And at the same time, in order to keep bond rates low, they purchase, the Federal Reserve purchases the government's bonds so that their borrowing costs can be kept nice and low. Now, the borrowing costs to the US government as it stands at this point in time, the 10-year is trading at 3%. So when you've got $17 trillion worth of debt and growing, you're looking at an interest bill of over $500 billion already this fiscal year. Now, as the Fed prints more and more money and the rest of the world looks at them and starts, well, you'd panic too. You'd be thinking, well, I'm holding a lot of this currency and you're printing so much more that what I'm holding has no purchasing power, and in fact it's looking like a Zimbabwe style situation, just to put it to the an extreme case. So the Fed has to do something to show the rest of the world that it's not going to keep on doing this forever, that this was just a temporary measure. And if you look at the last Fed meeting back in December, when the statement came out and the Federal Reserve puts its intention to taper its asset purchases to the tune of, it's only 10 billion a month, but 5 in mortgage-backed assets and 5 in treasuries. To me, it's not even a taper. Well, first things first, it's an intention to taper, and that intention to taper is totally data dependent. So if the data in January does not warrant a taper, well, guess what's going to happen? It's going to be put off for another couple of months. And as I always say, just because a person says they're going to do something doesn't mean that they are. I can just as well say I'm going skydiving tomorrow, and you might believe it, but the reality is I'm just talking. It's the same with the Fed. They talk about tapering, but until such times as they do it, and I'll explain why in a minute why they won't, you can bet that it's not. And the markets are still betting that way, in that the pound has hit a 5-year high against the US dollar, and the euro is now at a 2-year high against the US dollar. So if the markets believed that the Federal Reserve was going to taper, then those currency would be tanking against the US dollar, but they're not. And in fact, to put it, to take it even one step further, the Fed gives with one hand and takes back with the other. This is actually a funny game, in that if you look at the last Fed meeting and what actually has transpired, if you look at the differences in statements between that one and the previous one, yes, there is a mention of a taper, which may or may not happen depending on the data. But essentially, the differences in the two statements was that the Fed has actually loosened monetary policy even further, because essentially they were going to keep this emergency Fed funds rate of 0 right up till unemployment hits 6.5%. Well, they've removed that language, and they said that they will keep Fed funds rates at 0 for an extended period of time, even if unemployment falls below 6.5%. So as the market reacts to that statement and looks beneath the surface, people like myself realize that the Fed talks about taper, it's not going to do it, but in fact it uses that taper as an excuse to loosen monetary policy even further. Money is going to be cheaper than ever, and for longer, essentially. So in one foul swoop, it managed to fool the market into believing that it's doing the fiscally responsible thing of tapering its purchases, of letting the free market take over. Not going to happen. But it's now going to loosen monetary policy further, sort of to counterbalance that. So what's the reality? All they've done is loosen monetary policy by extending that Fed funds emergency rate of 0% for another couple of years. That in itself is a sign that the US economy is struggling. And it's not only struggling, it's basically in a zombie-like state. Because if you think about it, they have so much debt and they're so unproductive that the maximum rate of interest that they can really pay on their debt is 0. If it goes up from 0, they default immediately. What does that tell you about the state of the economy? And to illustrate that, to give you an example to illustrate how the economy is purely hooked, addicted to stimulus, you can liken the situation of the American economy to that of an elite sprinter. This sprinter has injured themselves and have a hairline fracture in their ankle somewhere. Now, the Federal Reserve would be the crazy doctor who approaches this sprinter and gives him a sock. He puts on the sock and he says, I'm going to give you a shot of morphine to make you feel better. And that morphine is the stimulus. Now, the athlete cannot see the state of his foot because he's wearing a sock, but he can feel that the injection is giving him relief. He's got no pain. He can train again. So as he gets back into training and he gets those injections every day, he feels that, yeah, he's performing all right. But the whole time he can't see the damage that he's doing to his foot. And eventually his foot's hairline fracture becomes a compound fracture and he's now really, really struggling. So you know what? The crazy doctor, Ben Bernanke, comes up with QE2. If the first lot didn't work, let's give him twice as much now. And you know what? He gets relief. He still can't see the condition of his foot, but he has relief, so he goes back into training. And then it's finally just all broken and all mangled now. He cannot walk on it. It's so unbearable that he's basically totally handicapped. But this time, Ben Bernanke steps up and he goes, you know what? These injections aren't enough. I'm just going to give you a bucket of morphine. And that essentially is what QE3 was. It's a bucket of morphine to infinity. And this guy can now run or walk or train on his totally busted ankle. And now we come to the taper. Now imagine if you were that elite athlete and you were managing to walk, just barely, forget even running, you were just barely walking on 8.5 injections a day. Now I'm going to come up to you and I'm going to say, you know what, I'm only going to give you 7.5 injections a day. First things first, you are going to collapse in pain because you've built up a tolerance to the morphine. And secondly, you won't even, the whole concept of reducing by that much, it's insignificant because you're still hooked on 7.5 injections of morphine a day. You first of all have not cured what's ailing you, which is the broken ankle. And you've actually put on a second problem in that you're now addicted to the morphine. And any tapering of it is going to really show the condition of you're going to feel the condition in your foot despite you not being able to see it. And at the same time, your addiction to the morphine is going to come to the fore, and you're going to realize, oh my God, what have I gotten myself into? Nothing's been repaired, and now I've got two problems. And that's what's the American economy staring at the moment. It's an economy that's barely coasting on stimulus. And just like the morphine, the opiate is basically using opiates or this stimulus is a game of diminishing returns, because the more you put in, the more the economy becomes tolerant and addicted. Same thing. But when you add more and more and more, the results become less and less and less with the same amount of dosage that you increase it by. So the first stimulus would have had the greatest impact because they may have put tens of billions or hundreds of billions into the economy, and that may have jolted it by 2 percentage points. But since then, they have to pump in trillions to try and achieve 0.5 percentage point of growth. And it mainly comes from the fact that the debt load is so huge. And that load is ultimately what's going to bring them unstuck. Now, the Fed's conundrum is that it does not want interest rates to go up. It talks about it, but it doesn't. Anybody in their right minds can see that the second interest rate goes up, or they don't even have to spike, they just have to rise, for argument's sake, 200 points on the 10-year to give a 5% number on the American debt, and you're looking at an interest bill of $850 billion, and that is almost half of the government's receipts through taxation and whatever. Now, what are the odds of the government taking half of their tax receipts to try and pay off this debt? Not going to happen. So essentially, they need to print $850 billion more dollars in terms of IOUs and hope that the creditors who already own all this debt is willing to accept these extra IOUs as payment, as interest payments. This has been going on for years. And when these crazy creditor nations wake up and realize that this is just political gamesmanship, that they're not really doing anything to lessen this debt burden, in fact, they're doing everything that they can to increase it, they're going to pull the plug. So as I said, the Federal Reserve is stuck between a very big boulder and a very, very, very hard place. It cannot let interest rate rise, but at the same time it has to try and make it look like it is allowing the free market to come in and let interest rise slowly so that the rest of the world keeps on buying their bonds, or even simply do not dump their bonds. Now, I don't know how long this game can last. This is human nature. You cannot tell somebody that what they're holding on is worthless if they're holding on to a whole pile of it, because the first thing that they do is they don't want to know about it. They believe that their perception of the American economy is good, it's positive. There is going to be a positive outcome out of this, and the Americans will be good on their debt. Well, I don't know how long this is going to take, but if you keep on having to add 800 odd billion, or whether it be 500 billion, or the current $300-400 billion interest payments on all these debt, and keep in mind that's just the government's debt. We haven't even looked at the 80 odd trillion dollars of unfunded liabilities that I mentioned earlier. There is no way that America can pull itself out of this debt spiral. So as debt begets more debt, and the 17 trillion accrues $400-500 billion a year, and that $400-500 billion a year accrue another few tens of billions in themselves over the year, and so forth, you're looking at an absolute catastrophe. The second catastrophe that's going to result is that the Fed, in an attempt to keep interest rates down, or bond yields down, has acquired $4 trillion essentially of these bonds, or on top of mortgage-backed assets. Now when interest rates go up, the Fed is looking at hundreds of billions of dollars of losses on its balance sheet. The Fed actually has no money. That's just taxpayers' money, or taxpayers' losses. And when you start to have a rout on these American toilet paper treasuries, it leads to a treasury crisis, to a currency crisis. Because when people start to sell these treasuries, like the Arabs, the Chinese, the Japanese, it's selling US dollars. And then the real run is going to happen, where it doesn't matter if the stock market keeps on going up, either through inflation or whatever. You're looking at a situation where the US currency is no longer really wanted, or is treated as the world's reserve currency, and so it's going to precipitate more and more selling. So if the stock market goes up 20%, but people realize that the US dollar is falling 40-50%, then what they're holding is worthless. So they're going to kickstart a drop in the stock market. But with rising yields comes a drop in the stock market anyway. So it's not only just about putting a facade for the rest of the world to see that they are letting the free market back into the market, which is not happening. They are simply there to print money to perpetuity, and to borrow money from all these creditor nations to perpetuity. Now, there's another point to consider when you look at these currency runs, or these stock market runs, or these treasury runs, is that essentially, if you were a person living in the US, I mean, right now, a third of American citizens are dependent on food stamps. Is this a signal of a healthy economy? I don't think so. But essentially, the consumer's tapped out. I say this time and time again. But there is absolutely no way that the Federal Reserve can and will taper realistically. Yeah, it doesn't matter if it's only 10 or 20 billion or 30 billion. They won't even do much beyond 10 billion, even if they attempted, because the economy is going to start to go into reverse. Just like that athlete's going to start to feel his foot, his ankle is really a lot worse than he was led to believe. Now, not only is the Fed not going to taper, but I have a strong belief that the Fed actually needs to increase these purchases. And I don't care what people say, it's written all over the place. The signals are there. Imagine if interest rates spiked. The Fed would be sitting on, if interest rates just rose a little bit, the Fed would already be sitting on a lot of losses. Investors are sitting on a lot of losses. Some people may opt to start to sell, as you say, cut your losses short and let your winners run. But what then happens to all the debt that's already out there and people who have to renew all their debt? Think of Apple, that threw out $17 billion in bond issuance at 2%. What happens when interest rates goes to 5%? Those bonds are going to be worthless. But essentially, Apple is actually not a good example because it's got all the cash in the world. It doesn't need debt. But picture all these junk bonds and all these companies that are not really creditworthy, who can issue junk bonds because of the low interest rate environment at the same price, the same rate as AAA rated sovereign bonds, of which I believe America isn't one of them. But they've put a lot of bonds out there and at low rates so they can fund whatever it is that they need to pay for. And there comes a time for bond renewals, for bond redemptions. Now, these companies who are laden with debt which could be rolled over cannot reissue debt at the same price should interest rates rise. So therefore, for companies that are already struggling, believe it or not, on all these infinitely cheap debt, they're going to go under. They're just going to become insolvent because they can't restructure their debt, and people won't be willing to buy their uncreditworthy debt at such low price. So when cost escalates for these companies, and there's no market out there, what's going to happen? Well, again, the Fed, if it has any money, has to come to the rescue and come to the fore and purchase these bonds in order to keep borrowing rates low for all these uncreditworthy companies. So the Fed not only has to expand its purchases of not only government treasuries and mortgage-backed assets, but it has to also venture into the corporate space. So it will be a market that when people realize that all these bonds are worthless, there's going to be only one buyer out there, and that's the Fed. And the Federal Reserve will become not the buyer of last resort, it will be the only buyer out there. And that time is going to come sooner than later, because inflation is going to rear its ugly head. Inflation is already rearing its ugly head, although this is a topic of another discussion anyway. And regardless of what the government agencies show in their data, it's there and it's getting worse. Because, as I said before, when you print a crap load of money, inflation, or I should say the rise in prices, inevitably follow. So therefore, when you keep on printing to perpetuity, then you're going to have an event known as hyperinflation, that just like the Zimbabwean dollar. And that in itself as I've said many times before, is the Fed's target. They lie about deflation, they lie about inflation numbers, because essentially they need to keep their license to print money, and the perception of keep the world's perception of them to be one of fiscal soundness and responsibility and responsible monetary policy. But no, all it is print money until the money becomes worthless, so that your debt will be, through inflation, forgiven. Because if you owe 17 trillion, but you actually have $100 trillion notes in circulation, you actually get $83 trillion change from all those creditors. It's an extreme example, but you get the picture. So that's the Fed's conundrum. And that's not the Fed's just the Fed's conundrum, it's the Fed and the policymakers, so the government. It's a huge conundrum. How do you let the market, the free market, take over without interest rates rising? And how do you put on a facade so that the world's perception of you is one of a great productive nation, and one that's recovered from the brink of the precipice of a financial destruction? Well, I'm not going to bore you with astrophysical terms or astrophysical terminology, but if you were to look at an example, the Fed believes, or people believe, that the Fed were at the event horizon of a black hole. That is the point of no return, the point in which you passed, in which you cannot go back and you're going to get sucked in. Well, and now it's pulled itself away from the event horizon, and it's drifting away and away and away, and now Ben Bernanke is going to hand the baton over to Janet Yellen so that she can see the rest of the trip home away from the black hole. Good perception. But the reality is, they've not only passed the event horizon, they're actually on the edge of the black hole itself, and they're about to get sucked in. And we are on the precipice. We are almost at a point in time when things are going to start to move, as soon as all these credited nations realize that they've been dudded, and that their perception of the American economy was totally wrong. The Federal Reserve is totally useless, and any credibility that they have is going to be shot. Now, talking of credibility, imagine what's going to happen to the stock markets or the Fed's credibility when they actually do taper. I don't care if it's 10 billion or 20 billion, and the economy goes into reverse, and they have to do an about face and remove the taper, and in fact have to increase their purchases, which they will do anyway. What signal would that send to the markets, whether it be bond markets, stock markets, or currency markets? You will see a rout. And Ben Bernanke is going to look back from retirement, be looking back at the whole situation from wherever he's retiring to, and he's going to say, I can't believe this has happened. I didn't see this coming. I mean, I handed the baton over to Janet. The economy was in superb shape. We were even tapering, and now she mucked it up. That's probably why they picked a woman. Sorry to all the women out there, but it's easier to blame on somebody that's got no experience. There's been no case of a female Fed chairperson, so it's easier to lay the blame on the person who's at the helm when the next crisis hits, than to blame the previous two Fed chairmen, both of which are equally culpable. But Ben Bernanke would be the person who is the chief financial destroyer in this instance, because he is the person who brought about all those quantitative easing programs. So I hope that you can see beneath the surface, and I hope that you can now form a clear distinction between perception and reality.